Hello everyone! Today we'll dive into a financial analysis of two Malaysian energy giants, Hibiscus Petroleum and Bumi Armada. Let's start with their core businesses.
How doctor, let me give you an introduction to stocks. First, Hibiscus Petroleum, a pioneer in oil and gas exploration, operating through PSCs in Malaysia and internationally. Its stock price is highly volatile, driven by oil price swings. Next, Bumi Armada, a leader in offshore energy service, specializing in FPSO operations and decarbonization solutions. Its diversified revenue stream provides relative stability. As of March 2025, Hibiscus trades at 1.46 ringgit, while Bumi Armada is priced at 0.54 ringgit. Despite their contrasting risk profiles, combining them could balance energy sector exposure. Let's explore further.
Okay, now here we come to the second part, standalone analysis. Now let's assess their individual risks based on volatility and annual returns. Bumi Armada stand out with the highest volatility at 19.53%, reflecting risk from contrast uncertainties and a high debt load. Hibiscus Petroleum is slightly less risky, with a volatility of 15.94%, but still faces exposure to oil price shocks. Meanwhile, the KLCI market index definitely remains the safest, showing a volatility of just 3.05%. Looking at performance from 2018 to 2022, Hibiscus delivers positive 8.42% in annual returns, outperforming the market, which recorded negative 3.26%. Bumi Armada, however, struggled, posting negative 13.11% due to financial leverage challenges and the sector headwinds. The key takeaway is Hibiscus is a better fit for moderate risk investors, while Bumi Armada is for those comfortable with high risk exposure and the potential turnaround opportunities.
Okay, this part I will introduce portfolio risk analysis. And now let's combine these stocks into the portfolio using their market value. Bumi am 3.5 billion. Hibiscus am 1.33 billion. The weighted average return is minus 7.19. This negative return highlights Bumi Armada drag on the portfolio. The portfolio's standard deviation is 17.54. Calculated like the picture shows, so sigma p equals to 17.54 with a 0.71 calculation. These stocks move in the tandem too often. True diversification requires adding assets like renewable or utilities to reduce sector concentration risk.
Okay, and the fourth part, optimal portfolio allocation. How do we minimize the risk? Let's calculate the optimal ways using the formula like this. We find 37.8% in Bumi Armada and 62.2% in Hibiscus Petroleum. To assess different portfolio structures, we compare risk levels and are equating 50% to 50%, aggressive weighting 70% to 30%, and optimal weighting 37.8% to 62.2%. Okay, in 50 to 50 allocations. Moderate risk is 18.2%, but suboptimal, and 70 to 30 allocation is higher risk. The risk about 19.1% due to Bumi's volatility. Optimal allocation is 37.8% to 62.2%. It's the lowest risk. 17.54% while preserving returns. And the caution is oil price swing and the geopolitical risk may render these weights obsolete. Regular rebalancing is critical. Yeah.
Hello, doctor. Let me introduce the beta coefficient of selected stocks and the security market line. Beta measures sensitivity to market movements. Bumi Armada's beta is 1.89, 89% more volatile than the market. Hibiscus Petroleum's beta is 1.76. That is still higher, but slightly safer. Both stocks carry high market risk, as indicated by their beta coefficients above 1. Bumi Armada is highly volatile, reacting sharply to market changes. A 10% market drop could result in an 18.9% decline for the stock. Hibiscus Petroleum also has above average risk, but is slightly less volatile than Bumi Armada. About the security market line. Here is the security market line as a picture. Using the formula about CAPM, we can get the Bumi's expected return is 14.17%, and Hibiscus expected return is 13.45%. Yet, their actual returns are lower, suggesting undervaluation. But is this a buying opportunity or a red flag? Let's dig deeper.
Hello everyone, today I'll talk about the seventh part, the EPS P ratio and the dividend policy. Now let's analyze the profitability and the valuations. Bumi Armada EPS dropped 19.4.3 from 2018 to 2025, and RM 0.035 to RM 0.068. The Hibiscus portfolio, the EPS growth 51.4%, RM 0.185 to RM 0.280. Despite the EPS growth, PE ratio classifies the Hibiscus 2.49 in 2025 with 15.2 in 2018. It 18.2% drop. The Bumi is 5.09 in 2025 with the 12.5 in 2018. 59% decline. The Bumi Armada settled around 14% dividend payouts, ideal for income struggles. Hibiscus is raising payouts 16.2 percent to 29.2%, signaling the confidence about limiting the reinvestments. The key insight: low PEs may reflect market skepticism about the earnings sustainability, not just universe. The investors must wise device against growth potential.
Next, let's summarize our key insights. First, Hibiscus Petroleum offers moderate risk with stable earnings growth, making it a solid choice for investors seeking long-term exposure to the energy sector. However, Bumi Armada, despite its higher volatility, shows signs of financial recovery, particularly in its recent contract renewals. Both stocks appear undervalued based on CAPM's expected return versus their actual performance. But this gap isn't just a buying signal. It reflects broader market skepticism about their ability to sustain growth amid oil price swings and debt pressures. Finally, even with the optimal allocation of 62.2% Hibiscus and 37.8% Bumi, our portfolio remains heavily tied to the energy sector. Through diversification demands and in assets like renewables or utilities.
The next is key findings. Our analysis revealed three critical contradictions. First, the EPS-PE paradox. Both companies grew earnings significantly. Bumi by 94%, Hibiscus by 41%, yet their PE ratios collapsed. This isn't just undervaluation, it's the market questioning whether these earnings can survive oil volatility or debt burdens. Second, limited diversification. Despite combining two stocks, their 0.71 correlation means they often move together. A market downturn could drag both down, leaving investors exposed. Third, dividend dilemmas. Bumi's stable 40% payout appeals to income seekers, but staffs growth. Hibiscus rising dividends signal confidence, but may limit funds for new oil fields. So what's the smart move? Let's wrap up with final recommendations. The 10th is final thoughts on selected stocks. Here's our strategy takeaway. For Hibiscus, we recommend a long-term hold, but only if you can stomach oil price swings, track OPEC decisions and global energy policies closely. For Bumi Armada, treat it as a speculative play. Its debt and contract risks are high, but a successful decarbonization project could drive upside. Monitor quarterly cash flow reports. Most importantly, diversify beyond energy. Add low correlation assets like solar energy stocks or consumer staples to hedge against sector crashes. Remember, low PE ratios are tempting, but never buy blindly. Wait for clear signal like oil price stabilization or Bumi's debt reduction before doubling down. Thank you.